Okay, thank you for joining me today. This is Yanko speaking. I was waiting for a few more attendees to join us, but let's just start, and I guess other people will join us a little bit later. So thank you for joining me today for this the last webinar of trading strategies for this week. We will start with a short review of the market, and then talk a little bit about another trading strategy today, one more, and maybe try to look during this hour, try to look for some trading opportunities with using some of our trading strategies we've learned. If I find, or if you find, and you can always post it, if you find any interesting opportunity on any pair, it doesn't matter. Here it's mostly the euro dollar on the screen. So yesterday evening we spoke about the TDI, the Traders Dynamic Index, and about the another trading made simple, another system here that uses the TDI, and we spoke a little bit about moving averages and how to work with moving averages and price actions or support and resistance levels in Confluence. Today I'll show you another trading strategy with Heikin-Ashi candles and one moving average, okay, 100 simple moving average, and the stochastic. So we'll review that shortly. Let's just make a quick review of the market. You know what, I'll just open a clean graph here, a clean chart. So you can see that the euro dollar is moving a little bit sideways this morning. Just a few, maybe an hour ago or a little bit less, there was a nice price action around here. Okay, so you can see here this support everywhere, and the price reacted and went up about 20 pips within I don't know, 15 minutes or less. And you can see it stopped somewhere around here in the near this support, near this this trend line, this resistance line. Okay, so it reached almost this resistance line and made like a double top here. Okay, or two candles like a tweezer, and went down. So you can see here the strong price action, or the strong support line. Basically, the euro dollar is now looking, I guess it's looking for a direction after finding its strong, very strong support around 124.40, and it remains to see whether it will manage to pull up again and make another move up, or if it manages to break this line, it'll probably continue going south towards the previous low around 122 something, or 123. So this is the euro dollar. The pound dollar. The pound dollar also shows some. It reached the 50 Fibonacci here. Okay, I think it was 50. Yeah, almost a 50 Fibonacci level here. Made this nice spinning top, which is a nice reversal candle. Okay, you can see it here, this reversal candle. This is a very strong reversal candle, and I'll show you this similar reversal candle on the pound dollar yesterday on the hourly chart. Okay, so you should always pay attention to these candles, and then gave another push up yesterday. Again, the direction is not very clear, but the general trend is still a downtrend unless it manages to break this previous high. But it has some more resistance levels before it manages to reach it. So You can see here that the pound is a little bit moving sideways now, not very clear trend. Again, if I see any special settings on it later on this week or next week, of course we'll discuss them. I just wanted to show you this reversal candle here yesterday. Okay, another spinning top. Look at it, how beautiful it is. Okay, with this area, this resistance area. So basically it looked like it breached this resistance area, okay, closed above, and then gave this candle here, found support, but eventually it broke again. And when I saw this candle, for me it was quite obvious it was going down. If we look at it on the 15-minute chart, okay, you can see here this long reversal candle, okay, and then these long wicks from above. So these weak wicks here all show you strong resistance, okay. 1, 2, 3, 4, 5, 6 wicks here, 6 candles with long upper wicks, and some of them are even sort of confirmation. Okay, you see this doji and this another spinning candle. So all these together, along with the 1 hour spinning top, give us a clear signal for reversal. Okay, and again, the top here is just even if you enter when where this candle closes around here, and you place the stop loss just above its wick, okay, like 20 pips above, okay, above the closing, which is about 5 pips higher of the wick. Still, it's not a very long stop loss, and you see here that it gave a 60 pip drop. So obviously the ratio here, even if you didn't know it would give such a big drop, okay, you could plan maybe a reversal around either to this trend line or stretch a Fibonacci level, Fibonacci retracement level, or use this support line to say, okay, maybe it'll go only down to the support. It's still over 40 pips, so the risk-reward ratio is at least 2 to 1. Okay, and in this case it was almost 3 to 1, so it's quite good. Okay, so when you plan your trade, also look how far can this trade go, and let's just put the Fibonacci level 2 and see. You can see here around the 61.8, okay, which corresponds to this resistance level here, or the 50, which corresponds to this resistance level here. Still, we can take about 40 pips versus 20 pip stop loss. It's good, okay. All right. So the euro, the pound, we can discuss 1 or 2 more pairs just before I show you the new trading strategy there. The dollar yen, I actually haven't tracked it much recently. No, it hasn't reached the trend line. You can see that the dollar yen made a very nice move upwards last week, and then gave these reversal candles. You can see here spinning top, another one, many reversal candles, and this nice shooting star. Okay, and after which a sharp drop came of about 100 pips and even a bit more. Okay, and generally you can see, okay, the nice price action around here, okay, somewhere around here. This is, you can see support, resistance, and resistance again, and again another reversal candle here. So just pay attention to these levels, to these areas, and it looks like it tried to form some sort of reverse head and shoulders, more or less, but didn't really make it. And excuse me just a sec. Okay. And let's just okay. And okay, I'm just looking to see if there's any potential divergence here. Okay, here there is a slight divergence, a small divergence here and here too. You can see this going up. Okay, these peaks going up with these long wicks, but the stochastic is giving us a hint of divergence. Okay, so just pay attention to these warnings or signals when you trade, and let's just take a look at the S&P in general. It also gives us let me just find it first. The S&P. Okay, I'm just opening naked charts here. Okay, so the S&P, we spoke about it last week. We talked about the potential head and shoulders, reverse head and shoulders, and eventually it didn't really manage to break above it, above the neckline. Okay, so there was this sort of left shoulder, head, right shoulder, and eventually it didn't make it and went down. But okay, but again, you can see it found support around this area here. You can see the stochastic already reaching overbought area. So we may see another drop of the S&P, maybe. Okay, especially if it, yeah, you can see here, support. Okay, around here, support, dropping, breaking the support and reaching higher towards the resistance area. Okay, resistance once and twice, and again, I guess we may see some drop here. I wonder if it'll be a major drop or whether eventually the S&P will manage to cross higher. But we'll talk more about with the trading strategy of today's session. We'll talk about exactly these signals of reversal on the stochastic when it reaches, especially when it reaches overbought or oversold areas, but not only. And again, for those of you who are looking for good setups, for nice trades, these are good setups. Okay, maybe you're not trading the S&P, but on any other currency pair, good setups when you see double top here, when you see resistance, when you see support that turns to resistance. These are the nice setups to take with small stop losses. You don't have to take a long or a large stop loss. And exactly these are the areas where you have the very safe trades. Okay, very safe trades. Although it looks like you're entering against the trend, you're actually going with the trend. Okay, because the general trend is a downtrend. Okay, it's a downtrend, and you're just you're entering with the trend around a resistance line. So these are the safest trades to take. They're very good. And if you look at the longer time frame and you see the stochastic already in an overbought area, okay, these are just like we called yesterday. These are the hidden divergences, which are divergences that give you continuation entries, okay, trend continuation entries. And again, it remains to see whether the S&P will manage to eventually keep dropping, or maybe it'll break it. But even if you enter here, okay, you enter around this area and you take something, okay, you start going with you enter right at the resistance line and the price starts dropping, you can pretty fast move your stop loss to break even or a small profit, so that even if eventually the S&P or whatever, another instrument, if they do reverse, you're still stopped out with a small profit and not with a loss. Okay, so that's the advantage of entering around these areas where you have quick reaction to this price level, and you can move your stop loss. You can set your stop loss pretty close, and you can move it pretty fast to the break-even point. Okay, so let's discuss a little bit our trading strategy for today. I remind you, yesterday we saw this trading strategy, which used Heikin Ashi candles with two moving averages, two exponential moving averages, 10 and 200. We spoke about the importance of the 200 EMA, and we added the TDI. Okay, we saw that when the candles are blue above the 200 EMA and crossing above the 10 EMA, okay, we're looking for long. And then when we have the green RSI, which is part of the TDI indicator, the green above the red and the yellow lines and above 50, that's a signal for long. And when we have the red candles below the 200 and below the 10 EMA, okay, below the 10 EMA, and the green is below the yellow and the red, okay, just like here, below the yellow and the red, and preferably below the 50, these are the short entries, okay, the signals to go short. Today, we'll discuss another trading strategy, similar but different, okay. It also uses Heikin Ashi candles, but it uses one moving average, the 100 EMA, the 100 SMA, simple moving average. Okay, so it's 100 simple moving average, and it uses the stochastic with the setup of, or the setting of 833. Okay, so you can set it up yourselves. You don't have to get any special indicators from anywhere. And this trading strategy has two steps. The first step is to look on the longer time frame. Let's say the daily. Okay, the daily chart, for example. You can always choose other trading time periods. Other periods, sorry. You can you choose, for example, the daily chart or the 4-hour chart or the 1-hour chart. You look for the longer time frame chart, and you're looking for the following setup. For long, what you're looking for is for the price to be above the 100 SMA, the 100 simple moving average, and Heikin Ashi candles should be blue, and especially with reversal candles, and we'll discuss that, we'll elaborate on that shortly, but we're looking for actually reversal areas. Okay, and so we're looking for a reversal, a change in the Heikin Ashi candles, and crossing of the stochastic, okay, crossing of the blue or the stochastic line when it crosses its signal line, the red one. Okay, so let's say we're looking here after this candle, okay, this reversal candle here. For long, okay, this gives us a doji, but again, it doesn't have to be a reversal candle, but we're looking for the Heikin Ashi to change from red to blue if we're looking for long positions, and we're looking for the price to start going above the 100 SMA. In this case, it went above the SMA 1 day later. But here we're looking for reversal. We're looking for the stochastic to cross above above the signal line, and then we shift to the shorter time frame. If we chose, let's say, 1 day, the daily chart, let's go to the hourly chart. Okay. Just a sec, let me find it. It was, where was it? Now I lost it. It was in February, 2011. Wow, that's a long time ago. Let's look for something closer. You know what, even even here, okay? Again, let's I'm just looking first for the reversal, but I'm looking, you know what, let me, okay, let's see here. We're looking for the reversal first, although it's below the 100 SMA, okay, but we'll see once it gets above the 100 SMA on the shorter time frame, okay. Obviously, this is a weaker signal, but I just first want to show you long signal. Obviously, we can see here that most of the time it was signals for short, but okay. So we see here a reversal candle. We see here how the red Heikin Ashi turns to a blue Heikin Ashi, and the stochastic here, the stochastic also crossed above. Okay, so we're looking here, and we're going to the shorter time frame. This is still 2011. Geez, this is October. Okay, October 2011. It does. I guess I need to. For some reason, it won't let me. Okay, you know what? I'll just pick the 4-hour chart to give you shorter time frame signals. Okay. Again, let's look for a long signal. Here, for example, I'm just looking for a reversal. Again, it doesn't have to be a clear reversal candle, but it has to be a change from blue to red in case we're looking for long signals, okay, and then I'll show you short signals, which we have here much more frequently. So we see here a downtrend, blue turning to red. We have here the crossing of the stochastic, okay, crossing from the blue crosses above the red, or the stochastic crosses above its signal line. We have a blue Heikin Ashi candle. In this case, since we're on the 4-hour chart, we'll try to time the entry. You know what, I'll leave it here. We'll try to time the entry on shorter time frames, not on the 1-hour chart. It may be a bit too close. Let's try on the 15-minute chart. Here it's February 16th. I guess it's really a problem. Okay, let's just it's too problematic to take it backwards, because with the demo account, I guess, yeah, okay. So we see here the February 16th, and we're looking, we know that here on this day we had a reversal. Okay, this is the reversal day. So now we know we have a reversal day on the Heikin Ashi, on the, in this case, let's say the 4-hour chart. Again, I prefer working with time with a difference of 2 periods. For example, the daily and the 1-hour chart, or the 4-hour chart with the 30-minute or 15-minute. Okay, but just for the sake of example here, for the long trade, we'll take 4-hour and 1-hour. And then, in order to time the entries, what we're looking for is for retracements towards the 100 SMA. Okay, on the shorter time frame, retracements, and again, reversal of Heikin Ashi from red to blue, from bearish to bullish candles, and crossing of the stochastic. So anywhere you see sort of a retracement, it doesn't have to be all the way, retrace all the way back to the moving average, okay, but some retracement and then reversal, okay, especially with reversal candles and crossing of the Heikin Ashi. Every time you see that, this pattern, you can look for an entry, and and enter with the trend. Okay, and you know that the longer time frame is still in a long trend. Okay, and for example, okay, we see here some retracement. We see here this reversal candle. Okay, so entering somewhere around here, taking long. Again, reversal candle with reversal of the of the stochastic. Reversal candle with reversal of the stochastic. And again, every time I see reversal of the stochastic after some sort of a retracement, remember we're looking at a long trend here. Okay, we saw the 4-hour chart with reversal. We know that the price is above the 100 SMA. We see the stochastic here giving us a reversal signal and the Heikin Ashi as well. Okay, so now I wouldn't recommend entering every time you see this the signal. Obviously, if you're already in a trade, let's say you entered somewhere here, wait for the trade to give you sufficient profit in order to re-enter. If you want to scale in and add more trades, wait for the trade to develop. Because if you enter too many trades very close to each other and the price doesn't move your way, you're losing on several trades at once. So let's say you enter in any of the entry points here, just let the trade evolve a little bit before you enter, and let's say have at least 30, 40, 50 pips before you enter again, before you add to the trade, so that even if you close the second or the third trade in loss, you still have enough profit from the first trade. So let's say you entered anywhere around here. Okay, it went up around 300 pips. Okay, so I guess you could enter. It doesn't matter. Let's say you entered somewhere here. You know what? Okay. Let's say you entered somewhere around here or around here. Okay. After 50 pips, it's somewhere here. You have already 40, 50 pips. Okay, and here you have an entry signal again. I would say here. Okay, somewhere here you have another entry point. This candle, no, the crossing of the stochastic is not very clear, so let's say here you entered again. Okay, after the stochastic crossed, just when this candle closed, and it's already about somewhere between 50 and 60 pips above the previous entry, and here you get another 60 pips, and okay, so if you enter here, you get another entry opportunity somewhere here or here, I would say. You know, maybe I wouldn't enter on this candle because this market, the price here is moving sideways and the candles are not very decisive. But here I have a clear bullish candle closing above this consolidation zone. So entering here with the stochastic crossing higher, and it's already about 70 pips above the previous entry. So again, sufficient room for mistakes if any occur. And you have here another 80 pips. So if you enter here and remain in the trade as long as it's above the 100 SMA, okay, you can take here somewhere like 200 plus 150 plus 100. Okay, so you can get plenty of pips. Now, the biggest advantage of this strategy, of this setup, is that once you get a strong trend and once you get a good trend and you re-enter, okay, and you scale in and scale in and scale in, you can get hundreds, if not even maybe 1,000 pips of one trend. If it's a long trend, you can get really a lot of many pips from one trend. as long as you have patience and you keep scaling in with sufficient room between each two trades, okay? Don't enter after 10 pips or 20 pips. Leave enough room so that even if, for example, you set your stop loss here, okay, somewhere here, let's say 20 pips, okay, then you still take two trades, both trades, okay, the first and the second in a profit or just a little bit above break even, okay. Don't enter if you don't have sufficient room to close both trades in a profit. The initial stop loss of the first trade and the following trades, the initial stop loss of the first trade can be somewhere below the Heikin Ashi candles, okay, below if you see a support area, or if you really want to have sufficient room, then below the moving average, okay, but that may be a bit too far. So just place it below the moving average only if you have a nice retracement towards this moving average. Okay. So that was an example of a long trade. When we're talking about a short trade, okay, you can here we have plenty of examples. Let's even look at the daily chart. Okay, so with the daily chart again, and not only the daily chart, in any chart, okay, the Heikin Ashi candles, the ones that give us really good setups for entry are the reversal candles. Okay, so when you see a reversal candle like this after a long trend, and sometimes it can be a false signal. Okay, here that's a reversal candle, and if we enter here, eventually it went up 100 pips more to the previous high. So here it was a false signal, but later on we got 2 days later we got another good signal. But if you look at these reversal candles, okay, and on the daily chart again, I remind you the stop losses may be too far away for you. So if you don't feel comfortable with the daily charts, look for signals on the 4-hour charts. Okay, but I remind you the entry is not on the daily chart, it's on the shorter time frame chart, like the 1 hour or 15 minutes or 30 minutes. Okay, so look for reversals and then look for entries. So let's say let's take now the for example this area here, or you know what, I would take for example this, just to take a close example. Okay, we see here an uptrend. We know that generally it's a downtrend. Okay, generally we know it's a downtrend, and we see here this these Heikin Ashi blue candles and then a reversal candle on the daily chart. And we go to the 1 hour chart. It's the beginning of May. We go to the 1 hour chart, and we look for an entry point. So you see here, well, it's actually it gave us almost 2 days here. I guess it was May 2nd or May, okay, whichever. So let's say this is where we had our you know what, let's just see, this was May 2nd. Okay, so May 2nd. Okay, here it is. It was this. It was here. This was the reversal day. And now on the 1 hour chart, we start looking for entry points. So again, if the market is going sideways with these hesitation candles or these porcupine candles, I wouldn't look for an entry point here specifically, but maybe later on. So well, let's skip this whole area and look here. So this could be a nice entry point. Okay, where we see this reversal of this candle here, this more decisive Heikin-Ashi candle after this uptrend. And again, I remind you, we're looking for short because we saw this reversal, this daily bearish daily candle. So we're looking for short signals, and you see we're below the 100 SMA on the hourly chart. So here it may be a short signal. Here that's a nice short signal, okay, with this Heikin-Ashi, this dodgy Heikin-Ashi. I would just maybe mark them like this. Okay, so that's a nice signal here. And this is a great candle to enter. Okay, you see this Heikin-Ashi, this doji here, and the stochastic gives us a reversal. You can see here the stochastic going up. Okay, going up higher than the previous high, although we don't have a higher high here. So that's also sort of a hidden divergence, hidden bearish divergence. And here, okay, it gave us almost about 50 pips. And again, you see here another reversal candle, and then the red candle. Okay, so after the red candle, we enter, and we get here another maybe 60 pips or so. And you see the stochastic crossing down, okay, crossing the blue below the red, or the stochastic crossing below the signal line. So this area here at the end of this candle to go short. And again, many signals here. So all these reversal candles, sometimes they will give you more pips, sometimes fewer. But again, since you know you're with the trend, okay, you're taking the trades with the trend, you don't have to worry so much, and you can always place your stop losses far enough. Obviously, when you enter in areas of consolidation or near support areas or resistance areas, if it's an uptrend, you should always be more careful. Okay, if you enter here and you see the price reaching the support line and finding support, close your trade. Okay, or if you think it's too close, don't open it. Okay, let's say you entered here. You have, then you would probably skip this entry, or if you entered here, yeah, you can enter around here. It's already 50 pips, so that's sufficient room. And if you entered here, you shouldn't enter here because it's only 15 pips. Okay, again, always enter with sufficient room between two trades. Don't overload your portfolio with too close trades. Give at least 50 pips between the trades. So let's say we took this one and this one, these two trades, then we would probably skip these two. And then again, we have something here. Around here, we see this reversal candle with and the stochastic crossing down. Okay, so let's say it's it's about 40 pips, and even if you skip it, you can always enter around here. Okay, at the end of this candle, it's 50 pips more or less below the previous trade, and again, okay, and after you take this movement here, again you have reversal around here, any of these candles. Okay, basically this is the reversal candle you should take. Okay, you have an uptrend, a retracement, and a reversal candle, a Heikin-Ashi reversal candle with the stochastic crossing down, and another very nice trade. So again, what you should look for is for the reversal or the trade, okay, the longer time frame on the daily or the 4-hour charts. Okay, any of these, for example here for short, You also have here a nice divergence, which gives you a great signal to go short. Okay. Here, for example, if you think the price or the market is reversing, and you decide to look for long trades, okay, then maybe you can get just one or two long trades on the shorter time frame, but then the market will continue going down, and once you have, if you entered and you see these hesitation candles, okay, if you see a reversal candle and then you don't see a decisive candle afterwards, okay, for example, here we have decisive candles, okay, showing us that the trend is evolving and developing strongly. But if you don't see afterwards confirmation candles for the trend you thought that would take place, just drop your trades or close them and look for clear trend. In this case, the downtrend continues, so you would probably be stopped out or just close your trades yourselves. And again, if you see here, let's say you entered here, or you looked for entry points around here for long, if you thought that this was the direction, then this candle shows you that this is not the direction, and you see generally it's a downtrend, so you better look for signals to go short rather than to go long. Okay, so after retracements, if you see areas of reversal back or continuation back to the trend, just take these signals. Okay. Where can you look for reversal patterns, okay, and go against the trend or against the longer time frame trend? In areas where you see, again, decisive reversal candles, okay, you see this, okay, this is like almost like an engulfing bullish. Not exactly, it's not engulfing, but it's a very, very big candle, okay. It's a very big candle here, a reversal candle, and you can see the stochastic crossing up, and you can see here the bullish divergence. Okay, so in this case, it's a better signal for a reversal. And then if you look for longer after this candle, okay, let's say this is the candle of June 1st, okay, then let's look for shorter time frame signals for after June 1st. Okay, for example, on the 1 hour, on the 30-minute chart, for example. I don't trade the 30-minute chart usually, but let's just for the sake of example take it. So this was the reversal day, and here we can start looking for longs, okay, for long trades. So we can see around here, okay, a bullish reversal, and the stochastic is crossing up after the price retraced a little bit towards the moving average. Okay, so we have here, you can set the stop loss below the moving average. It gives us a nice trade here, okay, about 100 pips during the day. Again, you can look for another trade around somewhere around here. Okay, obviously watch out for the resistance area, but if you do take this trade, okay, after the stochastic crossed and you see these reversal candles somewhere around here, it gives us another more or less 50 pips or less, and it's far enough from the previous trade. And again, we're looking for long trades as long as we know, and as long as you see on the 4-hour chart that the trade or the candles are still blue, okay, and up till this candle here, okay. So as long as you know, well, actually here, yeah, that was the last blue candle on the 4-hour chart. So after that, you would probably refrain from looking for long trades until the candles turn blue again. Okay, so you would probably wait until a few more days, and then you can start looking for long trades again. So again, it's a bit. I mean, it's not something that you get the clear signals just from an accordance or an agreement of 10 indicators at once. You have here only the moving average with the stochastic and the Heikin Ashi. You have more judgment here to do, and you have to take a look at the longer time frames once in a while, once every 4 hours or once a day. Okay, the trading here is for swing trades, and if you catch long moves here, okay, if you catch long moves and leave your previous trades open, okay, then you can take from one long trend. In this case, this trend was about 4 weeks. Okay, that's a lot of patience. These are swing trades, but you can take from one trend here hundreds and hundreds of pips. Okay, it doesn't. You won't find good setups every day. Okay, these are per pair. You can find setups, maybe 1 or 2 setups per month. But if you find good setups, and if you're patient enough to stay in these long trends and move your stop losses slowly and just track the charts, you know, on an hourly basis, not every minute. You don't have to stay in front of the graphs every minute. If you look for these good trends and you trade on several pairs in parallel, let's say you find nice setups on the euro dollar and the pound dollar or the Aussie dollar, okay, or let's say the dollar yen or some of the yens, okay, again, depending on your time zone. If you're European, I recommend trading on the European zone, trading zone, because then at night the movement is not as strong, and you don't have to stay up at night to see whether a big change takes place. Okay, if you're in the Asian or the Asian Pacific time zone, then you can trade more maybe the yens or the Aussie and the Kiwi pairs. Okay, where there is potentially more movement during your daytime. But again, if you take a few good trades a month and you leave them open, you can really take a lot from the market, and you don't have to waste too much energy on staring at the graphs every minute. Just, you know, sometimes it's really best to keep away from the charts and let the market move and give you and do its things and give you the pips on a daily or a weekly basis, and not necessarily on a minute basis. Okay. Again, look for the entry setups according to the daily or 4-hour chart. I remind you, what you're looking for is a reversal. For example, if we have an uptrend and then the Heikin Ashi, I remind you, the Heikin Ashi filters out noises. Okay, it filters out temporary reversals. So if a reversal does take place on the Heikin Ashi chart, it probably, not always, okay, not always, you can see here some noise, but it will probably give you longer moves. Okay, and be also aware of the longer trend, of the moving average, okay, its direction. If you trade with the longer time frame trends, okay, you will have more success and many more pips per trend, okay, and per trade. So again, if you see here, for example, this downtrend, and you know the price reached a trend line. And you can see here this bullish divergence, this hidden bearish divergence. Okay, we have one high here, one peak here, a lower peak here, but the stochastic is giving us the same peak, already overbought. Okay, this is a hidden divergence on the daily chart. That means a lot. When you have hidden divergence on the daily chart, or you have a divergence on the daily chart, this really gives you a great setup. And you know, maybe even the Fibonacci level here. So just look for these setups on, yeah, you can see here around the 76.4 or the 61.8. Okay, so these are the best setups to look for, the longer time frame setups, and then ride on their on the long time frame move. Okay, so you see the reversal around on the daily chart, and then you go to the 1 hour chart and start looking for the shorter time frame setups. Okay, and you know, this is, I'm going short. You're looking for the short signals, and if you have a short signal and it's far enough from the previous trade, which is still open, hopefully, okay, then you add up and you scale in, and you take for the first trade hundreds, and for the second trades hundreds minus 50 or 60, and for the third trade, and all in all, after 5-6 trades, when you close them all together, you have for a trend of, let's say, in this case 500 pips, you can take 2,000 pips, okay, or 1,500 pips, okay, and it's from one trend. It doesn't happen a lot, it doesn't happen all the time, but when you do catch these trends, they're worth every loss you had on the way. Okay, if you had previous losses which were small, this will cover up all your losses and give you and leave you with much more in your pocket. And just to show you a little bit about the strength of divergences, okay, on I think May 7th, 2010, was it the flash crash, or was it 2009? Just I think it was 2010. Yeah, I think the flash crash, or June, I don't remember. No, it was I think in July. Yeah, maybe. Well, I'll need to show you that there was a nice flash crash. If you remember that, the time when the market dropped by something like almost 10% at in one night, one evening on the S&P, and the euro dollar and other currency pairs also dropped hundreds of pips within minutes. Okay, and the thing is that there were premature signs or previous signs from really nice divergences. Well, I need to find it and show it to you. I'll look it up, and when I find it, I'll show it to you. The dollar yen, I remember, the euro yen. Let me just find it and show you on the daily chart. You can see how strong divergences can be. I think it was in 2010. Yeah, I think it was here. May 6th. Okay, you can see here this candle with this long wick. This candle here on May 6th, this one I'm talking about. Okay, this candle here. Let's just remove the Heikin Ashi for a sec. Okay, you can see this candle here on May 6th. It's a candle of 970 pips. A daily candle of 970 pips. Okay, now this drop here came after a few more drops. Okay, but this drop here was after the markets in the U.S. in the evening dropped almost 9 or 10%. and then went up again immediately. Okay, it was called a flash crash. But what I want to show you is that on the dollar yen, the same time, there were some very strong divergences here. This is the May 6th. Okay, you can see here the drop on the dollar yen, almost 600 pips. That's very rare for the dollar yen to move 600 pips per day. But look at this. Okay, look at this here. You can see this double top here. And let me just add the MACD. And you can see the strong divergences. This is double top. You can see the strong divergences on the stochastic and on the MACD on a daily chart. Okay, and I don't necessarily mean that every divergence will give you 600 pips per day, but the dollar yen had this very strong divergence, and the bearish divergence. The euro dollar had also, I think, around this date, a strong divergence. Where is it? Or maybe it didn't. Well, somewhere here. Well, no, the euro dollar was already in a downtrend, but the euro dollar was going down and the dollar yen was going down, and that's why the euro yen dropped that evening or that day about 1,000 pips. Okay, so this template, again, the template I showed you, I called it the swing Heikin-Ashi stochastic, okay, the swing HAS. It's for those of you who are more patient, who don't have much time to stare at the graphs, who just want to look for longer trends on the daily chart and then ride these trends on the hourly chart, for example, or maybe even on the 4-hour chart. Okay, I remind you, look for reversal, okay, when you have a trend, and then a reversal candle of the Heikin-Ashi with a reversal of the stochastic, and then you go to the shorter time frame and look for the shorter time frame trends according to the moving average. Okay, if it's a long trend, then go above the 10 SMA. Sorry, not the 10, the 100 simple moving average. If it's a short trend, go below the 100 simple moving average when the price retraces and then gives you a reversal signal on the shorter time frame again. Okay, and I remind you again, always look for these warning signals like divergences. You see here the price going up and then a divergence, and then you may see this reversal candle. That's a clear signal for short. Okay, and look at this beautiful downtrend, or these hidden divergences. Okay. You didn't have any questions, but if you have any questions, please feel free to ask. And like always, you're more than welcome to send me an email if you need any template or indicator of some sort. yanko.fx@gmail.com. I don't know what's with the ambulances here today. yanko.fx@gmail.com. Thank you for attending this webinar today. I'll be more than happy to see you again next week. Trade safely, trade well, good luck, and have a great rest of the week. See you again next Monday. Thank you very much, guys. As for your question, is it possible to access old sessions? The answer is yes. There's let me just open up my email for a second, look for the link. There are, not all the sessions are recorded, but some of them are recorded, and you can, I'll just send you the link, just a sec, YouTube. Here it is. Yeah, okay, so I sent all of you the link. Okay, I'll send it here too. This is the link for Forex Place channel on YouTube. you can see these webinars, not all of them, because sometimes for technical reasons, I can't record them, but you can see most of them there. Okay, you're welcome. So again, thank you very much, and goodbye.